If you don't understand what you're investing in, you're going to lose money. But when every finance influencer says to invest in index funds, it must be good advice, right? Let's ignore the fact that these are often the same influencers that pushed crypto scams and buying at the peak of the real estate market. So the million-dollar question is, are index funds as good as people say, or are they overrated? To get to the bottom of this, we must first understand what makes index funds perform so well. First, let's clear up some terminology. An index tracks the performance of a specific group of stocks and represents a particular industry or the economy as a whole. For example, let's say you wanted to get a sense for how the US economy is doing. You could look at the thousands of US companies in the stock market and try to come up with the average performance for all of them, but a much better approach is to find a smaller set of, say, 500 companies that represents the US and track their performance instead. This is exactly what the S&P 500 index is. A tracking of 500 US companies that represent the US economy as a whole. Now, you can't invest in an index because it's a representation of stocks instead of an actual product. But that's where index funds come in. An index fund is a portfolio of stocks designed to copy the index. So an S&P 500 index fund is a portfolio of stocks that aims to copy the S&P 500 index, often by having the exact same 500 companies in the portfolio. Now, you may have heard that index funds are great investments, but what is it that actually makes them so good? To answer that, we have to understand diversification. You're gonna wanna pay attention to this because I got scammed out of tens of thousands of dollars to learn this stuff at a place called University. And you're about to learn this for free in less than 5 minutes. In the world of investing, there's the concept of risk and return. Risk is how likely an investment is to lose money, while return measures an investment's gain or loss. The greater an investment's risk, the greater its potential return, and on the flip side, the smaller an investment's risk, the smaller its potential returns will be. But what if there's a way to keep an investment's returns while reducing risk at the same time? There are two main types of risk with a stock. The first is called systematic risks, which are risks that affect most companies and can't be controlled, such as interest rate changes, natural disasters, and economic recessions. The second type of risk is called non-systematic risk, also called specific risk, which is what I'll call it here because it's risk that is specific to a particular company or industry. These include things like management decisions, product recalls, or even labor strikes. The combination of an investment's systematic and specific risks is its total risk. And while nothing can reduce systematic risk, there is an easy way to reduce specific risk called diversification. Diversification is when you spread your investments around into a bunch of companies instead of just a single company or industry. Doing this will reduce specific risk since even if one company or industry goes through tough times, other companies can pick up the slack and everything will average out. It's also for this reason that indexes that track a wide variety of companies like the S&P 500 perform so well, as you're eliminating specific risk without affecting your returns. But although diversification explains why indexes like the S&P do so well, it doesn't really answer why a whopping 94% of the actively managed funds run by experts are failing to beat index funds over the long term, since those experts are also diversifying their investments. So what could the reason actually be? It turns out, the real reason active investors struggle to consistently beat the market is the same reason so many great things get ruined. Just think, what do Airbnb, Ticketmaster, and active investors all have in common? Fees. The answer is fees all along. Whether you're day trading yourself on Robinhood or investing in a professionally run mutual fund, there's going to be fees somewhere in the process. For an actively managed mutual fund, this is called the expense ratio, and while the percentage may look small, it's an absolute wealth killer when you consider that's the amount you lose in fees every single year. And this is where index funds can have an enormous advantage. Index funds are simply tracking the index they follow, so there isn't a team of analysts whose salaries you have to pay to research these stocks. In general, index funds have some of the lowest fees in the industry, as most of the work to run them is done automatically. Some brokerages like Fidelity even have zero-fee index funds, which they can do since the cost to run the index fund is so low that they can eat those costs themselves and charge no fees as a marketing tactic. So what does this mean for our index fund? Are they overrated? Perhaps unsurprisingly, no, they're not. The high praise they get is definitely justified, and now you can have some comfort in knowing that if you want a smart place to put your money, you just need to find an index fund that's well diversified with low fees, such as one of these S&P 500 index funds. If you're still worried about investing, why don't you check out these 8 common investing mistakes so you don't make them yourself? And subscribe for more 5-Minute Finance.